Introduction to real estate investing. Real estate investing involves purchasing properties to generate income or profit, rather than for personal use. It encompasses various strategies, from buying and renting out residential homes to developing commercial properties or investing in real estate funds. This field offers a tangible asset that can appreciate over time, providing a hedge against inflation and a source of passive income. Unlike stock market investments, real estate often allows for leveraging other people's money through mortgages, amplifying potential returns. Understanding the fundamentals is crucial for beginners to navigate this complex yet rewarding landscape effectively. It requires patience, research, and a clear strategy to succeed. This course will guide you through the initial steps. For beginners on a budget, real estate investing might seem daunting, but numerous accessible pathways exist. Strategies like house hacking, wholesaling, or investing in real estate investment trusts, REITs, require less upfront capital. The key is to identify opportunities that align with your financial capacity and risk tolerance. Building a strong financial foundation and educating yourself on market dynamics are paramount. This course emphasizes practical, budget-friendly approaches, demonstrating that significant wealth can be built incrementally. Starting small and scaling up is a common and effective trajectory for many successful investors. Why invest? Benefits and wealth building. Investing in real estate offers several compelling benefits, making it a popular choice for long-term wealth creation. One primary advantage is appreciation, where the property's value increases over time due to market demand, inflation, or improvements. Another significant benefit is cash flow, which is the net income generated from rental properties after expenses. This provides a steady stream of passive income, contributing to financial stability. Real estate also offers tax advantages, including deductions for mortgage interest, property taxes, and depreciation, which can reduce taxable income. These benefits collectively contribute to building substantial wealth over decades. Leverage is a unique aspect of real estate investing, allowing investors to control a valuable asset with a relatively small amount of their own money. By using a mortgage, you can acquire a property worth much more than your down payment, amplifying your potential returns. This means a small increase in property value can lead to a significant return on your initial investment. Furthermore, real estate provides a tangible asset that you can see, touch, and improve, giving investors a sense of control and security. It diversifies an investment portfolio, reducing overall risk compared to solely investing in volatile markets. These combined factors make real estate a powerful tool for achieving financial independence and generational wealth. Understanding risks and challenges. While real estate investing offers significant rewards, it also comes with inherent risks and challenges that beginners must understand. Market fluctuations can lead to periods of depreciation, where property values decrease, potentially resulting in losses if you need to sell quickly. Vacancy is another major concern for rental property owners, as empty units mean no rental income, but ongoing expenses like mortgages and taxes. Property damage, whether from natural disasters or tenant misuse, can incur substantial repair costs. Additionally, managing tenants can be time-consuming and emotionally taxing, involving issues like late payments, property damage, or eviction processes. These factors underscore the importance of thorough due diligence and a robust contingency plan. Liquidity is a key challenge in real estate. Unlike stocks, properties cannot be quickly converted to cash without significant effort and time. Selling a property can take months, especially in a slow market, tying up your capital. Interest rate changes can also impact profitability, as higher rates increase borrowing costs for new purchases or refinances. Legal and regulatory hurdles, such as zoning laws, landlord-tenant laws, and environmental regulations, add layers of complexity. Property taxes and insurance premiums can rise unexpectedly, eroding cash flow. Beginners must be prepared for these potential pitfalls by building an emergency fund, conducting comprehensive research, and seeking professional advice to mitigate risks effectively. Budget-friendly mindset and goal setting. Adopting a budget-friendly mindset is paramount for beginners entering real estate investing with limited capital. This involves a disciplined approach to saving, spending, and identifying creative ways to acquire properties without breaking the bank. It means prioritizing needs over wants, cutting unnecessary expenses, and actively seeking opportunities to increase your income. This mindset also encourages resourcefulness, such as learning DIY repair skills to save on maintenance costs or networking to find off-market deals. Thinking creatively about financing, like seller financing or partnerships, becomes essential. Cultivating this frugal yet opportunistic perspective lays the groundwork for sustainable growth in your investment journey. Setting clear, realistic goals is the compass that guides your real estate investment journey, especially when operating on a budget. Define what you want to achieve. Is it passive income, property appreciation, or a combination? Establish specific, measurable, achievable, relevant, and time-bound, SMART goals. For example, acquire one cash-flowing duplex within the next 18 months with a maximum out-of-pocket expense of $20,000. These goals help you stay focused, make informed decisions, and track your progress. Regularly review and adjust your goals as your financial situation and market conditions evolve. A well-defined roadmap prevents aimless investing and ensures every action moves you closer to your financial objectives. Assessing your financial situation. Before diving into real estate investing, a thorough assessment of your current financial situation is non-negotiable. This involves understanding your income, expenses, assets, and liabilities to create a clear picture of your net worth. Start by tracking all your monthly income sources and meticulously listing every expense, from housing and utilities to discretionary spending. This exercise helps identify areas where you can cut costs and free up capital for investments. Next, compile a list of all your assets, such as savings accounts, retirement funds, and any existing property, along with your liabilities, including credit card debt, student loans, and car payments. A clear financial snapshot reveals your capacity for investment and potential areas for improvement. Once you have a comprehensive overview, calculate your debt-to-income ratio, a critical metric lenders use to assess your creditworthiness. A lower ratio generally indicates better financial health and a higher likelihood of loan approval. Evaluate your credit score, as a strong score is vital for securing favorable mortgage rates. Work towards paying down high-interest debt, as this frees up cash flow and improves your financial standing. Building an emergency fund, typically 3 to 6 months of living expenses, is also crucial before committing to real estate. This fund acts as a buffer against unexpected vacancies or repair costs, providing financial security and peace of mind. This meticulous preparation ensures you enter the market from a position of strength. Market cycles and economic factors. Understanding real estate market cycles and broader economic factors is crucial for making informed investment decisions. Real estate markets typically move in cycles, characterized by periods of expansion, peak, contraction, and trough. During expansion, demand is high, prices rise, and new construction increases. The peak represents the market's highest point before a slowdown. Contraction sees declining demand, falling prices, and reduced construction. The trough is the lowest point, often followed by a gradual recovery. Recognizing which phase the market is in helps investors time their purchases and sales strategically. Economic indicators like interest rates, employment rates, and population growth significantly influence these cycles. Interest rates directly impact mortgage affordability and consequently buyer demand. Lower rates make borrowing cheaper, stimulating demand and pushing prices up, while higher rates have the opposite effect. Employment rates influence consumer confidence and the ability of people to afford housing, directly affecting rental demand and property values. Population growth drives the need for more housing, creating opportunities for investors in growing areas. Local economic factors, such as major employer expansions or contractions, can also have a profound impact on specific markets. By closely monitoring these macroeconomic and local indicators, investors can anticipate market shifts, identify emerging opportunities, and mitigate potential risks, ensuring their investment strategy remains agile and responsive. Finding your niche. Property types. Identifying your investment niche is crucial, especially for beginners on a budget, as it allows you to focus your resources and expertise. Different property types cater to various investment goals and risk tolerances. Single-family homes are often a good starting point, offering relatively stable rental income and appreciation potential, though they typically require more capital. Multi-family properties, like duplexes or small apartment buildings, can provide multiple income streams and economies of scale in management. However, they usually demand a larger initial investment and more complex management skills. Understanding the pros and cons of each type helps in aligning your investment with your budget and objectives. Beyond traditional residential properties, other niches exist that might be suitable for budget-conscious investors. Commercial properties, such as retail spaces or office buildings, generally require substantial capital and specialized knowledge, making them less ideal for beginners. However, some investors find success in niche areas like short-term rentals, e.g. Airbnb, which can offer higher income, but also demand more active management. Land investing, while requiring less capital upfront, can be a long-term play with no immediate cash flow. Real estate investment trusts, REITs, offer a way to invest in large-scale real estate portfolios without direct property ownership, making them highly accessible. Carefully researching and selecting a niche that matches your financial capacity and interest is key to a successful start. Introduction to financing options. Securing financing is often the biggest hurdle for beginners, especially those on a budget, but numerous options exist beyond traditional mortgages. Understanding these different avenues is critical for acquiring your first investment property. Traditional bank loans, while common, often require a significant down payment and a strong credit history. However, government-backed loans, like FHA or VA loans, can offer lower down payments and more flexible qualification criteria, making them more accessible. Exploring these options early in your journey can significantly broaden your investment possibilities. Each financing method has its own set of requirements, benefits, and drawbacks, which must be carefully evaluated against your financial situation and investment goals. Beyond conventional lending, creative financing strategies can be particularly advantageous for budget-conscious investors. Seller financing, where the property owner acts as the bank, can eliminate the need for traditional bank approval and often involves more flexible terms. Hard money loans, provided by private individuals or companies, offer quick funding for short-term projects, but come with higher interest rates. Partnerships and syndications allow investors to pool resources, enabling the purchase of larger properties that would be unattainable individually. These alternative methods require thorough understanding and due diligence, but can unlock opportunities when traditional financing is out of reach. Diversifying your knowledge of financing options empowers you to find the best fit for your specific investment needs. Traditional mortgages for beginners. Traditional mortgages, typically offered by banks and credit unions, are the most common way to finance real estate purchases. These loans usually require a down payment, often ranging from 10% to 20% or more of the property's purchase price. Lenders assess your credit score, income, debt-to-income ratio, and employment history to determine eligibility and interest rates. A higher credit score and a lower debt-to-income ratio generally lead to more favorable terms and lower interest rates, saving you significant money over the life of the loan. Understanding these requirements is the first step in preparing for a traditional mortgage application. It's essential to get pre-approved to know your borrowing capacity before seriously looking for properties. There are various types of traditional mortgages, primarily fixed-rate and adjustable-rate mortgages, ARMs. A fixed-rate mortgage maintains the same interest rate for the entire loan term, providing predictable monthly payments and stability. This is often preferred by beginners who value certainty in their budget. An adjustable-rate mortgage, on the other hand, has an interest rate that can change periodically based on market indices, potentially leading to fluctuating monthly payments. While ARMs might offer lower initial rates, they carry the risk of higher payments in the future. For beginners on a budget, carefully weighing the pros and cons of each type and choosing the one that best aligns with your financial comfort and long-term strategy is crucial. Consulting with a mortgage broker can provide personalized guidance. Government-backed loans, FHA, VA. Government-backed loans, such as those from the Federal Housing Administration, FHA, and the Department of Veterans Affairs, VA, offer excellent opportunities for beginners and those on a budget. FHA loans are insured by the government, reducing the risk for lenders and allowing them to offer more lenient qualification criteria. They typically require a lower down payment, often as little as 3.5%, making homeownership more accessible. While FHA loans are primarily for owner-occupied properties, a common strategy for beginners is house hacking, where you live in one unit of a multi-unit property and rent out the others. This allows you to use an FHA loan for an investment property, provided you occupy one unit. Understanding these specific programs can unlock significant investment potential. VA loans are another powerful option, exclusively available to eligible service members, veterans, and their spouses. The most significant advantage of VA loans is that they often require no down payment, making them incredibly attractive for those who qualify. Like FHA loans, VA loans are also primarily for owner-occupied properties, but they can be used for multi-unit properties, up to 4 units, if the veteran occupies 1 unit. This makes house hacking a viable strategy for veterans looking to enter real estate investing with minimal upfront capital. Both FHA and VA loans have specific property requirements, such as being in good condition and meeting certain safety standards. Researching the eligibility criteria and benefits of these government-backed programs is a smart move for budget-conscious investors looking for accessible financing. Creative financing basics. Creative financing refers to non-traditional methods of funding real estate purchases, often bypassing conventional banks. These strategies are particularly valuable for beginners on a budget, as they can reduce or eliminate the need for large down payments and strict credit requirements. One common method is seller financing, where the property owner directly lends the buyer the money, often with more flexible terms than a bank. This can involve a lower down payment, a negotiable interest rate, and a customized payment schedule. Seller financing is especially useful for properties that might not qualify for traditional loans or for buyers with less than perfect credit. It requires direct negotiation and a clear understanding of the terms between buyer and seller. Another creative approach involves lease options, also known as rent-to-own agreements. Here, a tenant leases a property with the option to purchase it at a predetermined price within a specific time frame. A portion of the monthly rent often goes towards the down payment, allowing the buyer to build equity while improving their financial standing. Hard money loans are short-term, asset-based loans provided by private lenders, typically used for distressed properties that need quick renovations. While they come with higher interest rates and fees, they offer speed and flexibility when traditional financing is not an option. Understanding these creative avenues expands your toolkit, enabling you to acquire properties that might otherwise be out of reach. But always remember to consult legal and financial professionals before entering such agreements. Partnerships and syndications. For beginners on a budget, partnerships and syndications offer powerful ways to enter real estate investing by pooling resources. A partnership involves 2 or more individuals combining their capital, expertise, and time to acquire and manage properties. This allows you to tackle larger deals than you could individually, sharing both the financial burden and the responsibilities. For example, one partner might bring the capital, while another contributes property management skills or renovation expertise. Clear communication, a well-defined partnership agreement, and aligned goals are essential for success. This collaborative approach can significantly reduce individual risk and accelerate your investment growth, making it an attractive option for those with limited personal funds but valuable skills. Real estate syndication is a more formalized type of partnership, typically involving a sponsor or general partner who manages the deal, and multiple limited partners who contribute capital. Limited partners are passive investors, providing funds but not involved in the day-to-day management, while the general partner handles all aspects of acquisition, management, and disposition. Syndications allow individuals to invest in large-scale commercial properties, such as apartment complexes or shopping centers, that would otherwise be out of reach. This method provides diversification and access to professional management, but it's crucial to thoroughly vet the sponsor and understand the terms of the offering. Both partnerships and syndications democratize access to real estate, enabling budget-conscious investors to participate in more significant opportunities and benefit from economies of scale. Wholesaling, low capital entry. Wholesaling real estate is an excellent entry point for beginners on a budget, as it requires minimal upfront capital. In wholesaling, you act as a middleman, finding distressed properties at a discount, and then assigning the purchase contract to another investor for a fee. You don't actually buy or own the property. Instead, you secure the right to purchase it and then sell that right. This strategy involves extensive marketing to find motivated sellers, accurately estimating repair costs, and building a strong net worth as cash buyers. The profit comes from the assignment fee, which is the difference between the price you negotiate with the seller and the price the end buyer pays for the contract. It's a fast-paced business that relies heavily on networking and deal-finding skills. The process typically begins with identifying motivated sellers, often through direct mail, online ads, or driving for dollars. Once you find a property, you negotiate a purchase agreement with the seller, ensuring it includes an assignable clause. Simultaneously, you market the contract to your network of cash buyers, who are typically rehabbers or landlords looking for investment opportunities. When a buyer is found, you assign the contract to them for a fee, and they close the deal directly with the original seller. While wholesaling can generate quick profits, it requires strong negotiation skills, a deep understanding of local market values, and the ability to quickly connect sellers with buyers. It's a low-risk, high-reward strategy when executed correctly, making it ideal for those looking to start without significant personal investment. House hacking strategy. House hacking is an ingenious strategy for beginners on a budget, allowing you to live for free or at a significantly reduced cost while building equity and gaining landlord experience. The core idea is to buy a multi-unit property like a duplex, triplex, or fourplex, or a single-family home with extra space, live in one unit or room, and rent out the others. The rental income from the other units or rooms covers a substantial portion, if not all, of your mortgage payment and other housing expenses. This drastically reduces your personal living costs, freeing up capital for further investments or savings. It's an excellent way to get started in real estate without the burden of a separate investment property mortgage. This strategy offers several advantages. First, you can often use owner-occupant loans, such as FHA or VA loans, which require lower down payments and have more favorable terms than investment property loans. Second, you gain hands-on experience as a landlord, learning about tenant screening, lease agreements, and property management firsthand. This experience is invaluable for future investments. Third, you build equity in your property, which can be leveraged for future purchases. Fourth, it provides a built-in emergency fund through reduced living expenses. While it requires living with tenants and managing a property, the financial benefits and educational experience make house hacking a powerful launchpad for aspiring real estate investors. It's a practical, budget-friendly approach to kickstart your portfolio and achieve financial independence. BRRRR method explained. The BRRRR method, buy, rehab, rent, refinance, repeat, is a powerful strategy for real estate investors, particularly effective for those looking to scale their portfolio on a budget. It involves purchasing a distressed property below market value, renovating it to increase its worth, and then renting it out to generate cash flow. The key to this method is the refinance step, where you take out a new loan based on the property's increased post-rehab value. This allows you to pull out most, if not all, of your initial investment, effectively recycling your capital for the next deal. This strategy enables investors to acquire multiple properties without continuously needing new down payments from their personal savings, making it highly scalable. Each step of the BRRRR method is crucial for its success. Buy involves finding undervalued properties, often requiring extensive research and negotiation. Rehab means strategically renovating to add value, focusing on improvements that yield the highest return. Rent ensures consistent cash flow and demonstrates the property's income potential to lenders. Refinance is the crucial step where you extract your capital, ideally at a loan-to-value (LTV) ratio that allows for maximum cash out. Finally, repeat involves using the returned capital to fund your next BRRRR deal, continuously expanding your portfolio. This method demands strong project management skills, a good network of contractors, and a solid understanding of financing, but it offers a clear path to significant wealth creation and portfolio growth. REITs, investing without owning property. Real estate investment trusts, REITs, offer an accessible way for beginners on a budget to invest in real estate without the complexities of direct property ownership and management. A REIT is a company that owns, operates, or finances income-producing real estate across a range of property sectors, such as apartments, shopping centers, hotels, and offices. They are often publicly traded on stock exchanges, similar to mutual funds, allowing investors to buy shares in a portfolio of real estate assets. This means you can invest in large-scale commercial properties with as little as a few $100s, gaining exposure to the real estate market without needing to secure a mortgage or deal with tenants. REITs are legally required to distribute at least 90% of their taxable income to shareholders annually, typically as dividends, making them attractive for income generation. Investing in REITs provides several benefits, including diversification, liquidity, and professional management. Since REITs are traded on exchanges, you can buy and sell shares easily, offering much greater liquidity than physical property. Your investment is diversified across multiple properties and sectors, reducing the risk associated with a single property. Furthermore, REITs are managed by experienced real estate professionals, eliminating the need for you to manage properties yourself. However, REITs are subject to stock market fluctuations and interest rate changes, which can impact their share price and dividend payouts. For budget-conscious investors seeking passive income and diversification in real estate, REITs present a compelling and low-barrier entry point. It's essential to research individual REITs and understand their underlying assets and management teams before investing. Location analysis and due diligence. The adage, location, 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 holds immense truth in real estate investing, especially for beginners. A property's location profoundly impacts its value, rental demand, and appreciation potential. When analyzing a location, consider factors like proximity to employment centers, schools, public transportation, and amenities such as parks, shops, and restaurants. Areas with strong job growth and desirable lifestyle features tend to attract more residents and command higher rents and property values. Research local crime rates, future development plans, and zoning regulations, as these can significantly affect an investment's long-term viability. A thorough location analysis helps you identify markets with strong fundamentals and growth potential, minimizing risk and maximizing returns. Due diligence is the critical process of thoroughly investigating a property and its surrounding area before making a purchase. It involves much more than just a casual drive-by. It's a deep dive into all aspects that could affect the investment. This includes reviewing property records, checking for liens or encumbrances, and understanding local market comparables to ensure you're paying a fair price. For rental properties, analyze local rental rates, vacancy rates, and tenant demographics. Engage professionals like real estate agents, inspectors, and attorneys to assist with this process. Skipping due diligence can lead to costly mistakes, hidden problems, and ultimately a poor investment. For beginners on a budget, meticulous due diligence is your best defense against unforeseen expenses and ensures you make informed decisions. Property valuation fundamentals. Understanding how to accurately value a property is a fundamental skill for any real estate investor, especially when operating on a budget. Overpaying for a property can severely impact your returns, while finding undervalued assets is key to profitability. The most common valuation method for residential properties is the comparable sales approach, also known as comps. This involves analyzing recent sales prices of similar properties in the same neighborhood that have sold within the last 6 months. Key factors to compare include square footage, number of bedrooms and bathrooms, lot size, age, and condition. Adjustments are made for differences to arrive at an estimated value for your subject property. This method provides a realistic market value based on what buyers are actually willing to pay. For income-producing properties, such as rental units, the income approach to valuation is often more relevant. This method focuses on the property's potential to generate income. Key metrics include gross rent multiplier, GRM, which compares a property's price to its annual gross rental income, and capitalization rate, cap rate, which relates the net operating income, NOI, to the property's value. A higher cap rate generally indicates a better return on investment. Another important calculation is cash-on-cash return, which measures the annual pre-tax cash flow against the total cash invested. Mastering these valuation techniques allows you to make data-driven decisions, identify good deals, and avoid costly mistakes, ensuring your budget-conscious investments are sound and profitable. Calculating ROI and cash flow. Calculating return on investment, ROI, and cash flow are fundamental for assessing the profitability of any real estate deal, especially for beginners on a budget. ROI measures the gain or loss generated on an investment relative to its initial cost, typically expressed as a percentage. A simple ROI calculation involves dividing the net profit by the total cost of the investment. For real estate, this often includes the purchase price, renovation costs, and closing fees. Understanding your potential ROI helps you compare different investment opportunities and prioritize those that offer the best returns for your capital. It provides a clear metric for evaluating the financial efficiency of your investment. Cash flow is the net amount of cash moving into and out of your investment property. Positive cash flow means your rental income exceeds your operating expenses, mortgage, taxes, insurance, maintenance, vacancies, resulting in a profit each month. Negative cash flow, conversely, means expenses outweigh income, requiring you to cover the difference out of pocket. For budget-conscious investors, positive cash flow is paramount, as it provides a steady income stream and reduces financial strain. To calculate cash flow, subtract all monthly expenses from the total monthly rental income. Always factor in a vacancy rate and a budget for repairs. Prioritizing properties with strong positive cash flow ensures your investment is self-sustaining and contributes to your financial goals rather than draining your resources. Inspections, appraisals, and legalities. Thorough property inspections and appraisals are non-negotiable steps in real estate investing, especially for beginners on a budget, as they protect you from unforeseen costs. A professional home inspection identifies structural issues, faulty systems, HVAC, plumbing, electrical, and potential hazards that might not be visible during a casual walkthrough. This report can be a powerful negotiation tool, allowing you to request repairs or a price reduction from the seller. An appraisal, conducted by a licensed appraiser, provides an independent estimate of the property's market value. Lenders require appraisals to ensure the property's value supports the loan amount, protecting both you and the bank from overpaying. Never skip these crucial steps, as they provide vital information and safeguard your investment. Navigating the legal aspects of real estate is equally important. Engaging a real estate attorney is highly recommended to review all purchase agreements, contracts, and closing documents. An attorney ensures that your interests are protected, that all legal requirements are met, and that there are no hidden clauses that could lead to future problems. Understanding local zoning laws, property line disputes, and any existing easements or covenants is also critical. These legalities can significantly impact how you can use or develop a property. For rental properties, familiarity with landlord-tenant laws is essential to avoid legal disputes. While these steps involve additional costs, they are an investment in protecting your overall financial investment and ensuring a smooth, legally sound transaction. Always prioritize legal due diligence to prevent costly future complications. Self-management versus property managers. Deciding whether to self-manage your rental properties or hire a professional property manager is a critical decision for beginners, especially when balancing budget constraints with time commitments. Self-management allows you to save on management fees, typically 8 to 12% of gross monthly rent, directly impacting your cash flow. This option is suitable if you have ample time, live close to your properties, and are comfortable handling tenant relations, maintenance requests, and legal compliance. It provides direct control over your investment and a deeper understanding of its operations. However, it demands significant time and effort, requiring you to be available for emergencies and proactive in addressing tenant needs. For 1 or 2 properties, self-management can be a cost-effective choice. Hiring a property manager, while incurring fees, can save you considerable time and stress, making it a valuable investment for those with limited time or multiple properties. Property managers handle all aspects of tenant relations, including screening, lease agreements, rent collection, and evictions. They also coordinate maintenance, conduct property inspections, and ensure compliance with landlord-tenant laws. Their expertise can help you avoid costly mistakes and find reliable tenants more efficiently. For beginners who are new to landlord responsibilities or live far from their properties, a good property manager can be invaluable. Weigh the costs against the benefits of saved time, reduced stress, and professional expertise to determine the best approach for your investment strategy and lifestyle. It's a trade-off between direct control and delegated responsibility. Tenant screening and lease agreements. Effective tenant screening is paramount for successful rental property investing, protecting your asset and ensuring consistent cash flow. A thorough screening process helps you find reliable, responsible tenants who will pay rent on time and care for your property. This typically involves checking credit reports to assess financial responsibility, conducting background checks for criminal history, and verifying employment and income to ensure they can afford the rent. Contacting previous landlords for references is also crucial to gauge their past behavior as tenants. Establishing clear, non-discriminatory criteria and applying them consistently is vital to comply with fair housing laws and avoid legal issues. Investing time in robust screening upfront minimizes future headaches and financial losses. A well-drafted lease agreement is the backbone in any landlord-tenant relationship, clearly outlining the rights and responsibilities of both parties. This legally binding document should cover essential terms such as the rent amount, due date, late fees, and security deposit details. It must also specify the lease term, rules regarding pets, maintenance responsibilities, and procedures for renewals or termination. Using a legally compliant lease agreement, preferably one reviewed by an attorney or obtained from a reputable real estate association, is crucial. Never rely on verbal agreements. A comprehensive lease protects your interests, clarifies expectations for tenants, and provides a framework for resolving disputes. For beginners, understanding and utilizing a strong lease agreement is fundamental to professional property management and safeguarding your investment. Maintenance, repairs, and budgeting. Effective maintenance and repair management are crucial for preserving property value, ensuring tenant satisfaction, and controlling costs, especially for budget-conscious investors. Proactive maintenance, such as regular HVAC servicing, gutter cleaning, and pest control, prevents minor issues from escalating into expensive problems. Establish a clear system for handling tenant repair requests promptly and efficiently for beginners. Learning basic DIY skills can save significant money on small repairs. However, always know when to call a professional for more complex or safety-critical issues. Neglecting maintenance can lead to tenant turnover, property damage, and legal liabilities, ultimately eroding your investment returns. A well-maintained property attracts and retains quality tenants, contributing to long-term profitability. Budgeting the maintenance and repairs is a critical component of financial planning for rental properties. A common rule of thumb is to allocate 1% of the property's value annually for maintenance, though this can vary based on the property's age and condition. For example, a $200,000 property might require $2,000 per year. It's also wise to set aside a separate emergency fund specifically for unexpected major repairs, such as a furnace replacement or roof leak. Regularly review your maintenance budget and adjust as needed. Tracking all repair expenses helps you understand true operating costs and informs future investment decisions. By meticulously planning and budgeting the maintenance, you can protect your asset, ensure tenant happiness, and maintain healthy cash flow, even on a tight budget. Tax implications and insurance. Understanding the tax implications of real estate investing is crucial for maximizing your returns and avoiding costly mistakes. Property owners can often deduct various expenses, including mortgage interest, property taxes, insurance premiums, and operating costs, which can significantly reduce taxable income. Depreciation is another powerful tax benefit, allowing you to deduct a portion of the property's value each year, even if its actual value is appreciating. However, when you sell a property, you may be subject to capital gains taxes. For beginners, it's essential to consult with a qualified tax professional or accountant who specializes in real estate. They can help you navigate complex tax laws, ensure compliance, and identify all eligible deductions to optimize your financial outcomes. Proactive tax planning is key to long-term profitability. Adequate insurance coverage is non-negotiable for protecting your real estate investment from unforeseen events and liabilities. Landlord insurance, which differs from standard homeowners insurance, typically covers property damage from perils like fire, storms, and vandalism. It also includes liability coverage, protecting you if a tenant or visitor is injured on your property. Depending on your location, you may also need specific policies like flood insurance or earthquake insurance. Always review your policy carefully to understand what is covered and what is excluded. For budget-conscious investors, balancing comprehensive coverage with affordable premiums is important. Shop around for quotes and consider bundling policies. Never skimp on insurance, as a single catastrophic event could wipe out years of investment gains. Proper insurance provides peace of mind and safeguards your financial future. Building your real estate team. Building a strong real estate team is essential for success, especially for beginners on a budget who may lack certain expertise or time. Your team acts as your support system, providing specialized knowledge and services that are crucial for navigating the complexities of the market. Key team members typically include a knowledgeable real estate agent who understands investment properties, a reliable mortgage broker to help with financing, and a competent real estate attorney for legal guidance. These professionals can save you time, money, and stress by providing expert advice and handling critical aspects of your transactions. Don't underestimate the value of surrounding yourself with experienced individuals who can guide you through the process. Beyond the core trio, other professionals can significantly contribute to your success. A qualified accountant or tax advisor specializing in real estate can help you optimize your tax strategy and ensure compliance. For properties requiring renovations, a trusted contractor or handyman is invaluable. If you opt for property management, a reputable property management company becomes a key team member. Networking with other investors can also provide mentorship, insights, and potential partnership opportunities. For budget-conscious investors, leveraging the expertise of others allows you to scale your efforts without needing to become an expert in every single aspect. Invest time in finding and vetting these professionals, as their expertise will be a cornerstone of your real estate journey. Exit strategies and portfolio growth. Having clear exit strategies is as important as your entry strategy in real estate investing, especially for long-term wealth building. An exit strategy defines how you plan to realize your profits or transition out of an investment. Common exit strategies include selling the property for a profit, which is often the goal after appreciation and value-add renovations. Another strategy is refinancing to pull out equity, which can then be used to purchase more properties, effectively repeating the BRRR method. This allows you to retain the cash-flowing asset while freeing up capital for further growth. Planning your exit from the outset helps you make informed decisions throughout the investment lifecycle and ensures you meet your financial objectives. It's about knowing when and how to capitalize on your hard work. For budget-conscious investors, strategic portfolio growth involves leveraging initial successes to expand your real estate holdings. This could mean using the cash flow from your first property to save for a down payment on a second, or utilizing the equity from a refinanced property for a new acquisition. Consider diversifying your portfolio across different property types or locations to mitigate risk. Continuously educate yourself on market trends and new investment strategies. The goal is to create a compounding effect, where each successful investment fuels the next, gradually building a substantial and sustainable real estate portfolio. Patience, discipline, and a long-term vision are crucial for scaling your investments and achieving significant financial independence through real estate.